Okay, so our current playbook, we have a playbook. I don't want you to think, folks, that because of this inflation call that we've been early on and continuing with, and we're modifying it slightly here and there. Now it's more focused on this greenflation. But the bottom line is we still see a wonderful playbook ahead of us, but it's a playbook that's very 1973, 4 or 5. You know what I'm saying? It's the playbook that was used in the 70s when the inflation was similar to today, and it's never the same. What did well? Value did well. What did poorly? Overpriced growth. That's it. So we need to be mindful of valuation like that. Been talking about valuation extensions for a long time, and we've seen the extended valuation multiples. That's coming to fruition. They're right-sizing themselves. And yes, there very well may be some wonderful diamonds in the rough amongst the rubble there, and clearly we're doing that. We're looking for special growth situations where we could buy a good growth company at a fraction of its former multiple. But bottom line is you want to be more value. You want to overweight cash because you want to respect the volatility. With this environment, we expect, and we've seen, of course, a lot of volatility in the markets, and therefore we want to respect volatility. And how do you take advantage of that? How do you use the volatility to our benefit as investors? We overweight cash. We feather in. We have a buy list that we over-research. We do a lot of fundamental research with some technical overlays, and we look for our buy list, our favorites that meet our thematic our thematic approach, and then we buy them. We buy them when they're being thrown out and it's indiscriminate selling and it's saying, get me out. Okay, we'll buy a little. And now we're buying, high free cash flow yields. We're buying dividend paying, oftentimes blue chips that we've done the research on, and we're buying them at good prices. Not suggesting they're at the bottom. That's why we feather. Okay, that's how you do it. We're underweighting fixed income. We want to be cautious there. Stay shorter term, stay high quality, if at all. Again, dividend growth, value style, high free cash flow yielders. That's where we want to be. On the sector sides, again, inflation centric. We talked about real assets, infrastructure, resource companies, commodities, companies with pricing power. And again, can't hear from me without me saying the water sector is something that we can't ignore. You know what's happening. We're running out, demand is high, and we need infrastructure in water. Okay, but lest you've forgotten, timing does not work. So do not think for do not have the belief that we could time this thing. That's why we feather, right? That's why we take our time and put capital to work. It's not a thing where we say, oh, get all in and get all out. That's nonsense. Because look, if you just miss the best 50 days out of, this is 19, how many days is this? It's got to be thousands, right? And if you just miss the the best 50, you're down 1.7 versus per year. This is the average annual compounded annual rate. That's huge. This slide's even better. 952,000. This is a hypothetical growth of $10,000 invested in the S&P, right? 1980. Okay, so if you stayed in, you did a Rip Van Winkle. You woke up in August 31st of this year, 40 years later. You had 952,000 from 10,000. That's pretty cool. So that's a nice number. It's probably close to 10% per year. That's the average of the S&P. However, if you were, brilliant, and you thought you were brilliant, and you were timing, and you got in, you got out, and you happened to miss just five out of all those days, 40 years worth of market days, you missed five, the best 590. If you missed just the best 50, 68. This is unimaginable, the impact of this. That's why we want to keep our core portfolio well researched, understand the macro picture, And then around the edges, we manage, we tweak, we feather. That's how you invest. 60-40 no longer works. We've talked about this a few years back in the endowment pickle piece. I'd say that 3 times fast. And in that particular piece, we talked about how endowments, which are typically 60-40, philanthropic portfolios or nonprofit endowments, pensions, etc., they're typically 60-40. And yet, because of the fact that the fixed income portfolio has given us nothing for the last few years with the low interest rates, many folks are trying to become 90-10 and go more towards equity. And that's, of course, very risky. So we think it's probably a time to be more allocated in overweight the cash, be cautious on the fixed income, and then, of course, your equity exposure be more inflation-centric and be more particular to the resource companies and the value style that we talked about. Where are the opportunities hiding? And there are opportunities. There always are. That's what makes this job so exciting, is that there's always an opportunity, but you've got to be keen, you got to be skeptical, you've got to do the homework. This is not a market to throw a dart against the wall and buy the prettiest ETF and become a winner. That worked over the last 15, 20 years, maybe. No more. That game is over. We're back to that Rukeyser-like, that Wall Street Week kind of fundamental analysis. Got to read, got to work, got to do the numbers. So we've done that, and we believe that valuations on high growth companies, not yet, but they've certainly come down dramatically. So they're on our research. We're researching them. We're looking for the companies that might have a great addressable market with great management and a great product. And now they used to be up here on the valuation, and now they're down here maybe. So you feather in a little bit, perhaps. Also, this is similar. This is the top 40 S&P 500 companies taking out financials and real estate by their long-term, the last 12-month free cash flow yield. So you're talking about, versus the S&P. So these companies are, they've come down a bit, and now they're picked up. This is a very good free cash flow yield. So this could be interesting. Energy still cheap. We've talked about this for a while now. That's been one of our earliest calls on the energy sector. And again, for those of us who are for whatever reason, and we respect this, of course, who do not want energy exposure in their portfolio, we've got a solution that's called water. It provides you with the ESG modifieds you need or want, but it also gives you that resource and inflation-centric sector that is still attractive. Looking for opportunities, we're finding also in pockets like Japan. Very interesting. Japan topped out in 1989, and they're still 30 or 40% below. I mean, it's dramatically undervalued over the last 40 years. So maybe they're getting to be a point where they're changing. So we're looking at that as being an opportunity. Emerging markets is also ex-China. Even China is interesting, but they have such issues where we're not sure we want to stick our toe there yet. But emerging markets is interesting. Of course, the war and the dollar strength is causing some issues here. So it's on a back burner for us, but we're watching it. European stocks, we're talking about blue chip European companies that have been around forever. Here is, these have opportunities as well. Small caps are cheap, very cheap. Small cap value especially. And with respect to the foreign exchange risk, we don't see that with small cap because they're mostly U.S.-based companies. They don't have the multinational footprint, so therefore they don't have the FX drag. So that's interesting. And again, we talked about how value style it's been all growth for so long, but we think there's an opportunity, much like there was after the .com crash, and value resurged because value does, you'll see in a moment, they do very well when inflation is high. So history says buy inexpensive, high quality small caps and then sell low quality small caps when the Fed hikes. So you want to stay high quality and value centric. And here's the slide I mentioned about how value is done well. The bottom 20% of the stocks by PE, ergo value, right? And therefore you could see even in the difficult 70s how the value style did nicely.